Hello everyone, this is Victor here. Welcome back to the Intelligent Investor channel. In today's video, I'm going to analyze Palantir stock to see if it's a great company for long-term investing or if it's overhyped right now. About 2 years ago, I made this Palantir stock analysis video. I was bearish on Palantir stock because there was too much hype on Palantir in 2021. During that time, many investors and YouTubers were hyping Palantir stock and speculated that Palantir may grow 10x or more and become one of the largest mega cap stocks. So many investors bought Palantir near the peak in 2021. I also did not like that Palantir always added back large stock-based compensations every quarter to make the earnings look much better. In my opinion, using adjusted EBITDA and adding back large stock-based compensations every quarter to make earnings look better is very misleading. So that was why I was bearish on Palantir in 2021. Fast forward to today, Palantir is still down more than 20% since I made the first bearish video about Palantir. In comparison, both the QQQ Nasdaq 100 ETF and the SPY S&P 500 ETF did outperform Palantir a lot during this period here. To be fair, Palantir did recover a lot this year, mainly because of the current AI hype. At the time of making this video, Palantir did recover more than 150% year to date this year. Now, many investors who are very bullish on Palantir are betting that Palantir will become much more profitable going forward. Also, many investors are betting that Palantir will benefit a lot from the large demand for generative AI, large language models or LLMs, and other AI applications that will likely transform many industries and government agencies. So in this video, I'm going to talk about these topics to see if Palantir is a great business for long-term investing or if it's an overhyped AI stock right now. I will talk about Palantir's biggest risk and red flags, Palantir's long-term growth prospects, and whether I think Palantir will grow 10x or more going forward, Palantir stock valuation, and will I buy Palantir stock? If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock reviews and investing videos a week that will help you become a great investor. Each video usually takes me 20 to 30 hours to make, so if you like this channel and want to support it, check out my Patreon blog in the video description. Our goal is to help all members grow their stock portfolios to over 7 figures over time. Once you become a Patreon member, you can follow all the stocks I'm investing in for the long term and download the latest intrinsic value calculators for all the stocks I'm analyzing, so you will know when a stock becomes undervalued, fairly valued, or overvalued now. Also, you will have access to all my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. Before I start, I always like to talk about the biggest risk and red flags first. So this is the bearish perspective, where many YouTubers who are very bullish on Palantir don't talk about the risk. This is a huge red flag for me. If many YouTubers and investors are hyping Palantir, Palantir is likely overvalued. This is why I didn't invest in Palantir 2 years ago in 2021 when Palantir stock was near the peak. So here's the bearish perspective. Most bears believe that Palantir stock is still too expensive and overpriced based on Palantir's expected revenue and earnings growth, 4P and 4PS multiples. Many bears may point out that Palantir uses adjusted EBITDA, adjusted margins, adjusted earnings per share, and adjusted free cash flow to make the company's earnings look much better. These adjusted financials can be very misleading for regular investors. Palantir tends to have very large stock-based compensations every quarter. This dilutes existing shareholders' ownership, so this is not good for long-term shareholders. Also, the biggest risk is this. Many bears believe that Palantir's revenue growth has slowed down a lot in recent quarters. So why do I think Palantir is likely overvalued now? At the time of making this video, Palantir has very high forward valuation multiples. For example, Palantir's 4P ratio is around 71 and its 4PS ratio is nearly 15. Also, you can see its price to free cash flow ratio is around 100. All these ratios suggest that Palantir will need to have very high revenue and operating income growth rates going forward to justify these high valuations. This suggests that Palantir is likely overvalued at the time of making this video. This is from Seeking Alpha. Here you can see Palantir's 4P is expected to be around 77 in 2023 and its 4P is expected to be around 33 by the end of 2027. This suggests that its current 4P is way too high and it will take 4 to 5 years for its 4P to be more reasonable at around 33. We're not even factoring Palantir's increasing number of shares outstanding every quarter. So all these forward multiples suggest that Palantir is likely overpriced a lot at the time making this video. If you follow Warren Buffett and Charlie Munger, you will know that Warren Buffett and Charlie Munger often criticize Wall Street for using EBITDA to make company earnings look better. For example, Warren Buffett does not like companies using EBITDA. He believes that adding back non-cash expenses such as depreciation, amortization, and stock-based compensations can be very misleading to shareholders. Adding back non-cash expenses such as depreciation and stock-based compensations is a very common practice for many high-tech companies that are still in the very early growth stage, like Palantir. I also have the same view as Warren Buffett and Charlie Munger. Palantir always uses adjusted free cash flow, adjusted net income to shareholders, adjusted EBITDA, and adjusted EPS to make its earnings look much better every quarter. In my opinion, this is a huge red flag. These adjusted financials are very misleading. This is because management is trying to say that these are non-cash items, so therefore they are not really expenses. At the time of making this video, Palantir's Q2 earnings are not out yet, so I'll show you the Q1 earnings here as an example here. Palantir reported a GAAP net income of nearly $17 million in Q1, but after adding back all these items here, most of them are considered non-cash expenses. Palantir's adjusted EBITDA became much higher at $133 million. The biggest non-cash expenses here are stock-based compensations, depreciation and amortization, and payroll taxes related to stock-based compensations. If these are not real expenses to a company, then what are they? Think about this, if Palantir pays cash to employees and executives instead of stock options, Palantir will have much lower adjusted EBITDA and much lower free cash flow every quarter. Here's another thing we should consider. Palantir is a software as a service data analytics company. Like most software companies, Palantir will continue to give more stock options to employees and executives every quarter in order to retain them. This means we should expect that Palantir's diluted shares outstanding will continue to grow for at least the next several years until Palantir becomes much more profitable and starts buying back a lot of shares. In my opinion, these large stock-based compensations or stock options are real costs to shareholders. Eventually, Palantir will need to buy back shares if Palantir does not want to dilute too many shares. I believe Palantir's biggest risk is this: Palantir's revenue growth will likely slow down going forward. For example, Palantir's revenue is expected to grow about 16% year over year in 2023. This is much lower than the revenue growth rates in the past several years. If the US economy slows down a lot or heads into a recession over the next 12 to 24 months because of high inflation, high interest rates, or other negative macro headwinds, I think Palantir's government clients may cut back their spending on Palantir's Gotham platform, or Palantir's commercial clients may cut back their investments on Palantir's Foundry platform, as well as the upcoming artificial intelligence AIP platform. To be fair, Palantir has been growing its revenues consistently every quarter, and the company has been reducing its GAAP operating losses for many quarters already. Also, Palantir has a very healthy balance sheet. For example, in Q1, Palantir had around $2.9 billion of cash and marketable securities. In comparison, Palantir has zero short-term and long-term debts. More importantly, Palantir has been generating consistent free cash flows for many quarters already, so this is a good indication that Palantir has been improving its margins and profitability over time. But again, the biggest risk I see is that Palantir's revenue growth will likely slow down going forward, which makes the stock overpriced if you look at the forward multiples I just talked about earlier. So what are Palantir's long-term prospects, and will Palantir grow 10x from here? First of all, I think the bulls are mostly right about Palantir's improving profits, expanding margins, and growing revenues going forward. Palantir is expected to have real GAAP operating income and GAAP net income going forward. I believe Palantir's revenue will continue to grow at least for the next several years. This is because Palantir is acquiring more commercial clients in addition to government clients, acquiring more contracts every quarter, expanding to more industries, benefiting from the increasing demand for generative AI, and releasing the upcoming artificial intelligence AIP platform that will incorporate more AI capabilities and large language models into its existing platforms. Based on what I know, Palantir is one of the leading data analytics software firms in AI and machine learning. As of now, there's a large demand for generative AI and large language models or LLMs that have the potential to transform many industries. So the current AI trend, in my opinion, will likely benefit Palantir going forward. However, many bulls believe that Palantir will grow 10x or even more going forward. In my opinion, I think Palantir growing 10x or more going forward is pure speculation and it's too optimistic. Here's why I think Palantir growing 10x or more going forward from the current market cap is not realistic. Palantir growing 10x means that it will be larger than the three largest software as a service companies such as Intuit Inc., Salesforce, and Adobe. As of now, if we compare Palantir's current market cap around $35 billion to the largest SaaS companies in the US, you can see Intuit Inc., Salesforce, and Adobe's market caps are around 47 times bigger than Palantir. However, if we compare Palantir's free cash flow to the largest SaaS companies, you can see Intuit Inc., Salesforce, and Adobe's free cash flows are around 9 to 27 times larger than Palantir's free cash flows. As of now, Intuit Inc., Salesforce, and Adobe are much more profitable than Palantir across all the profitability measurements here. Realistically, for Palantir to grow 10x or more, Palantir will need to have much higher revenue, much higher operating income, and much higher free cash flow than the largest 3 software-as-a-service companies. Personally, I don't think that's going to happen. All these financials suggest that Palantir is likely substantially overvalued now compared to Intuit Inc., Salesforce, and Adobe. Many investors who are bullish on Palantir are betting that Palantir will be included in the S&P 500. Palantir CEO Alex Karp said that Palantir is likely eligible for the S&P 500 index, even though Palantir has a stock structure that gives the majority voting power to the founders. I believe Palantir will eventually be included in the S&P 500. This is because Palantir is expected to start having GAAP operating income and GAAP net income in most quarters going forward. One of the requirements to be included in the S&P 500 is that Palantir needs to have positive GAAP net income for the most recent 4 consecutive quarters, as well as the most recent quarter. For example, according to the latest guidance here, Palantir is expected to break even and have real GAAP net income in each quarter throughout 2023. This is a good sign because it indicates that Palantir will likely have real GAAP operating income in most quarters going forward. This is why I think Palantir will eventually be included in the S&P 500 going forward. This assumes Palantir will continue to expand margins and become more profitable. Now, for Palantir to have growing government revenue and commercial revenue going forward, Palantir will need to offer very compelling products such as the Gotham platform for government agencies, the Foundry platform for commercial clients and non-government clients, and the upcoming artificial intelligence AIP platform that will bring large language models and more generative AI capabilities to Palantir's commercial and government clients. Personally, I do not have access to Palantir's software platforms, so I wouldn't know how competitive Palantir's software technologies are compared to other competitors. Software for data integration, visualization, and analytics. Of course, as long as Palantir is continually innovating and creating great software platforms for clients that will solve their problems, we should see Palantir will have more commercial customers, more government customers, higher contract value, higher billings, higher total value, and higher average value per customer over time. So all these are very important metrics that will show how compelling Palantir's software platforms are going forward. Again, I don't have access to Palantir's software, so I wouldn't know how competitive or disruptive Palantir's platforms are compared to competitors. I want to show you Palantir's expected revenue growth rates going forward. Palantir is a software-as-a-service data analytics company. Similar to other software-as-a-service companies, Palantir is aiming to achieve the Rule of 40 going forward. The Rule of 40 means that a software company like Palantir should have a combined revenue growth rate and EBITDA margin of 40% or higher for the business to be sustainable and profitable over the long run. If a software company like Palantir cannot maintain a combined revenue growth rate and EBITDA margin of 40%, the business may eventually have cash flow and liquidity problems. In a recent earnings call, Palantir's management said that they're striving to achieve the Rule of 40 throughout 2023 and beyond. I think this is very important because it indicates that Palantir's expected revenue growth rate should be around 20% each year if its EBITDA margin is around 20%. Palantir's combined revenue growth rate and EBITDA margin should be around 40% or higher each year for the business to be sustainable and profitable over the long run. If Palantir becomes more profitable later on and has a higher EBITDA margin than 20%, then we can expect that Palantir's revenue growth rate will likely slow down and drop below 20% going forward. I want to show you this consensus revenue forecast here. Wall Street analysts expect that Palantir's revenue will grow by about 16% in 2023 and above 19% each year over the next several years. If we average out Palantir's expected revenue growth rates, Palantir's average revenue growth rate should be around 22% each year over the next several years. I think these revenue growth rates are reasonable because they are consistent with the Rule of 40 I talked about earlier. This is assuming Palantir's EBITDA margin will be around 20% each year. I think these revenue growth rates assume that Palantir will benefit from generative AI, more contracts from government and commercial clients, higher billings, and higher revenues per customer going forward. These revenue growth rates also assume that there will not be a large recession in the US in the upcoming months. In terms of EPS forecast, you can see Palantir's EPS is expected to grow from 21 cents per share in 2023 to 50 cents per share in 2027. Obviously, it's very hard to predict Palantir's EPS growth over the next 5 years, especially if Palantir will have more share dilution going forward. But the important part is this: the forward PE is expected to drop from around 77 in 2023 to around 33 in 2027, which is still very high. Again, this suggests that Palantir is likely overvalued at the time making this video. I want to show you how to calculate Palantir stock's intrinsic value here, so you will know when Palantir becomes undervalued, fairly valued, or overvalued. If you want this calculator, you can download it from my Patreon blog. The link is in the video description. These are the key assumptions in this calculator. First, I define Palantir's intrinsic value as its future free cash flows discounted to the present day. I'm using a discount rate of 12.5% here. I'm using a higher discount rate here because I think Palantir has a lot of risks. You can always use a higher discount rate here if you want to be more conservative. I expect Palantir's free cash flow margin should be around 18% over the next 5 years. This is slightly higher than Palantir's past 12 months free cash flow margin of 17%, because I'm assuming that Palantir's margins will be improved slightly over time. Based on the expected growth rates and the rule of 40 I talked about earlier, I believe Palantir's total value will grow by around 20% to 25% each year over the next several years. Then Palantir's total value growth will likely slow down more going forward, similar to other software as a service companies. Let's go over these 3 case scenarios here: worst case, normal case, and best case scenarios. Under the worst case scenario, we're forecasting Palantir's revenue will grow at a compound annual growth rate CAGR of 20% over the next 5 years. If we forecast Palantir's free cash flow over the next 5 years and discount the free cash flow to the present day, Palantir's intrinsic value should be around $19 billion for the entire company, or $8.70 per share. I'm giving this scenario a 25% probability here. Under the normal case scenario, we're forecasting Palantir's value will grow at a CAGR of 22.5% over the next 5 years. Then Palantir's intrinsic value should be around $21 billion for the entire company, or around $9.50 per share. I'm giving this scenario a 50% probability here. Under the best case scenario, we're forecasting Palantir's revenue will grow at a CAGR of 25% over the next 5 years. Then Palantir's intrinsic value should be around $23 billion for the entire company, or around $10 per share. I'm giving this scenario a 25% probability here. If we add all these numbers here, Palantir's intrinsic value should be around $9.50 per share. I also used the forward price to sales valuation model here to estimate Palantir's intrinsic value, which should be around $26 billion for the entire company, or almost $12 per share. If we take the average of both valuations here, Palantir's intrinsic value should be around $10.68 per share. Just to compare, Morningstar estimated Palantir's intrinsic value to be much lower at $9 per share. This means I believe Palantir's stock is likely substantially overvalued at the time of making this video. So will I buy Palantir stock? Personally, I'm not planning to buy Palantir stock, mainly because I believe the stock is well overpriced above its intrinsic business value. 2 years ago, when I made the first Palantir stock analysis video, I was bearish on Palantir. Now I'm more neutral on Palantir because Palantir is starting to have consistent GAAP earnings and more consistent free cash flows. I'm not planning to buy Palantir stock because I believe it's overvalued. More importantly, there's still too much AI hype driving the stock. Also, many investors and other YouTubers are hyping Palantir. This reminds me of what happened in 2020 and 2021, where many investors were hyping Palantir near the peak. So I'm simply staying away from Palantir now. I'm not shorting Palantir. I believe there are many software companies that are much better and much more profitable than Palantir. For example, this is one of my personal gold stock portfolios. I also have other portfolios with almost the same stock and the same investing strategy. This portfolio is doing very well because I've invested in some of the best businesses that are most competitive in their industries. I also bought many of them when they were much more undervalued before. If you look at this portfolio here, you can see I have invested in software companies such as Microsoft, Adobe, Intuit Inc., and Salesforce. I like these businesses much more because they are already profitable and they are the best in their industries. They have large economic moats, great products and services, great return on invested capital, increasing earnings, and increasing free cash flows over time. More importantly, they are the best and the most competitive in their markets. It's very hard for competitors to compete with them. So instead of chasing potential 10x growth stocks like Palantir or other hyper-growth stocks, I like to invest in the best businesses that are already profitable and that are most competitive in their industries. More importantly, I like to buy them only when their stocks are below their intrinsic business values in order to reduce risk. Personally, this long-term investing strategy has worked very well for me for many years. Now, all these are only my opinions and my analysis based on my research. They are not financial wise. There are always risks associated with investing. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.